If you're checking in for your daily briefing, you already know the vibe. Bitcoin has certainly been a volatile beast this past quarter, giving us that intense Q4 correction. But right now, things have settled. We are firmly in a phase of stabilization and consolidation, coiling really tightly. Yet, beneath this quiet price action, the foundations of the ecosystem are being pulled in two wildly different directions.
That's the core tension we extracted from the source material. We are looking at a structural dichotomy at play. I mean, on one side, you have this rapid, constructive policy acceleration happening in Washington, which is creating these massive long-term tailwinds.
Okay, that's the good news.
But simultaneously, we have these persistent, really high-profile security and credibility risks that keep institutional players, grounded in caution. The price action stuck just below that psychological $90,000 level. It perfectly reflects this institutional indecision.
Okay, let's unpack this. We always start with the charts because they tell us what the smart money is actually doing, not just what they're saying.
And the charts are, well, they're shouting caution. Look at the weekly close on Sunday, December 21st, which landed near $88,000.
Right.
That close confirmed a critical rejection right at the $90,000 resistance level. Hitting that wall established a pretty undeniable short-term bearish bias for the start of the trading week.
And what's interesting is how the lack of institutional activity sort of solidified that rejection. The sources pointed out the total absence of a strong Sunday buy wall.
Exactly. When you see smart money allocators, the big institutions, sitting on their hands like that, it signals a distinct lack of urgency. They are not trying to front-run the Monday open.
They're just watching.
They are still actively digesting that massive leverage flush that liquidated weaker players earlier in the quarter. Their cautious approach cements that $90,000 to $92,000 region as a truly formidable band of overhead supply.
Okay, so to put that in human terms for you listening, what exactly does overhead supply mean here?
It means that area is now packed with what we call trapped longs. These are the investors who bought Bitcoin hoping it would break 90,000, and now they're underwater.
So they're just waiting to get out.
Every single time the price attempts to revisit that level, these trapped investors breathe a sigh of relief and they rush to sell their holdings just to exit at break-even. That constant selling pressure turns former support into current, very painful resistance.
Looking at the last 24 hours, the market has been classic chop, trading within a tight box. What was it, about 87.6 to 89.9? It's hovering near 88.6 as we speak, totally stuck in that indecisive range.
And the technical patterns reinforce that indecision, but with a leaning toward fragility. Analysts have identified a textbook rising wedge breakdown on the daily chart.
For those who aren't constantly watching chart patterns, explain the psychology of a rising wedge. What's happening there?
It's fundamentally a pattern of exhausting buying pressure. Think of it like this. Buyers are managing to push the price slightly higher each time, forming higher lows.
Okay, so it looks strong on the surface.
Right, but simultaneously, the high points are getting rejected sooner and sooner. The momentum needed to sustain a rally is just running out of steam, indicating that the move is often, structural exhaustion rather than sustainable growth. It's a classically bearish sign.
So if that wedge breakdown plays out, what are the critical defensive targets we need to watch?
The immediate area is the local low around 85,150, but the real line in the sand, the level that technical analysts are really concerned could trigger a cascading liquidity hunt, is the pool below 80,540.
Wow, okay.
If that breaks, the market expects a swift, painful drop. To invalidate this immediate bearish thesis and confirm the bulls are back in control, we need a high-volume, decisive 4-hour close above $89,000. We just haven't seen the conviction for that yet.
That paints a picture of technical fragility and institutional caution. But that's only half the story. The policy landscape, which you called the governance paradox, seems to be moving at warp speed, creating a massive forward push.
That's where the dichotomy truly exists. We have this constructive legislative movement emerging at the exact same moment that destabilizing enforcement news is hitting the wire, making the ground, shaky for institutions.
Let's start with the huge positive. The Digital Asset PARITY Act. This is a bipartisan discussion draft unveiled by Representatives Miller and Horsford, focused on tackling the single greatest hurdle to Bitcoin usage, tax friction.
The cornerstone, the absolute must-have feature, is the de minimis exemption. This proposes exempting small crypto transactions, specifically those under $200 from capital gains reporting.
Why is that under $200 detail the holy grail, as the source called it? Doesn't this just save me a few cents on my coffee purchase?
It saves you way more than cents. It saves you a monumental administrative headache. Currently, if you buy a coffee with Bitcoin, you have to track the cost basis of that Bitcoin from when you acquired it, calculate the minute capital gain or loss, and report it to the IRS.
Which is impossible. Nobody does that.
It is impossible complexity for mass commerce. By exempting transactions under $200, the Parity Act essentially unlocks the Lightning Network for genuine, frictionless, everyday retail use. It makes Bitcoin a spendable currency rather than purely a taxable asset store.
That's a fundamental shift in perception and utility. But the bill tackles more than just small payments. It addresses stablecoins, which have huge implications for global commerce.
Correct. The bill introduces stablecoin modernization through what's called a deemed basis rule. So think of this as the IRS treating your regulated dollar-pegged stablecoin effectively as a dollar bill in your physical wallet.
So no more tracking those tiny fluctuations.
Exactly. It eliminates the complex reporting on minute fluctuations. Say, if your dollar-pegged stablecoin traded at 1.0001 for a second, that removes administrative absurdity and signals a genuine regulatory recognition of regulated stablecoins as payment instruments.
And finally, let's talk about mining and staking. The industry has been plagued by this concept of phantom income, where you owe tax on an asset you've earned but haven't yet sold. How does the Parity Act address that risk?
It stabilizes their cash flow. The proposed fix states that rewards from mining or staking would not be taxed upon receipt. Instead, taxation is deferred until those assets are actually sold or disposed of for fiat.
That makes so much more sense.
It perfectly aligns taxation with realized liquidity, reducing the huge pressure on miners who otherwise have to sell newly mined Bitcoin immediately just to pay the tax bill on their earned rewards.
These sound like sweeping, massively bullish changes. But to achieve this level of maturation, there's always a trade-off. What is the compromise written into this legislation?
The necessary trade-off is the application of wash sale rules to digital assets. This is standard practice in traditional equities markets. It prevents traders from intentionally harvesting losses for tax purposes, selling an asset at a loss to reduce taxable income,
And then just buying it right back.
and then immediately repurchasing that exact same asset to keep their position.
Exactly.
So this is a move to standardize crypto markets with traditional finance, but it also removes a very popular active trading strategy for tax optimization.
Precisely. It signals a move toward market maturation, limiting short-term maneuvering in favor of long-term stability and compliance. It's painful for some traders, but it's necessary for institutional acceptance.
Now, for the flip side of this governance paradox, the destabilizing political headwind of the Blanche Memo scandal, the policy tailwind runs right into a credibility issue here. This creates substantial headline risk that could easily chill institutional confidence. ProPublica revealed that Deputy Attorney General Todd Blanche held significant crypto assets, valued somewhere between $159,000 and $485,000, at the time he issued the pivotal Blanche Memo on April 7th, 2025.
And the importance of that memo really cannot be overstated. It was the policy document that dramatically shifted the regulatory approach in the U.S.
It was a watershed moment. It directed DOJ prosecutors to pivot entirely away from the aggressive regulation by prosecution strategy. It explicitly ordered the cessation of regulatory probes for things like unlicensed money transmission and disbanded the National Cryptocurrency Enforcement Team, or NCET.
Right. Everyone in the industry breathed a huge sigh of relief.
A collective sigh of relief, believing the rules of the road were finally being clarified.
But the conflict is that Blanche issued this industry-shaking document before he completed his ethics agreement to divest those substantial crypto holdings.
Correct. He was required to divest within 90 days. When he finally did so in June 2025, he didn't sell the assets on the open market. He gifted them to his adult children and a grandchild. This action, while maybe technically permissible, it raises major questions about the spirit of ethics compliance.
What's the strategic implication here? Why should the market care if a politician gifted his holdings?
Because institutions that moved into the market relying on the light-touch regulatory cover promised by the Blanche Memo now face political instability. If the policy is perceived as tainted by conflict of interest, Political opponents will have the leverage to pressure the DOJ to reverse course and potentially reestablish the aggressive NCET.
So that certainty just evaporates.
This uncertainty, the risk that the regulatory environment could abruptly pivot back to aggression, is chilling for firms needing long-term stability.
I want to jump into the security divergence next, because the metaplanet structure seems to be designed specifically to bypass the kind of institutional skepticism that ongoing security failures, like the recent Binance allegations, reinforce. Here's where it gets really fascinating.
The security risks certainly remain, confirming the second side of our structural dichotomy. A Financial Times investigation alleged that Binance failed to stop hundreds of millions in suspicious flows, even after its record $4.3 billion settlement with U.S. authorities.
What were the key findings of that investigation?
They identified 13 specific accounts linked to sanctioned terror financing networks across Venezuela, Syria, and China that moved massive sums. Evidence showed conflicting global logins happening within hours, suggesting shared illicit access and deep systemic control failures within Binance's compliance framework.
It underscores that systemic compliance gaps remain in centralized infrastructure, and the regulators will likely respond with further punitive actions. But while this centralized infrastructure is struggling with compliance, corporate balance sheets are evolving their Bitcoin accumulation strategies in truly sophisticated ways. Enter Metaplanet.
The Japanese firm Metaplanet is leading this innovation. They received shareholder approval, and this is crucial, backed by Norway's massive sovereign wealth fund, NBM, to issue a new Class B Mercury preferred stock. They are planning to raise approximately $135 million for further Bitcoin accumulation.
This is a sophisticated financial engineering move designed to solve a perennial problem faced by companies like MicroStrategy: dilution. How does preferred stock solve that problem?
Well, when a company issues common stock to buy Bitcoin, they dilute the existing shareholders' ownership percentage. Metaplanet's Class B stock is different. It's a yield-bearing instrument, meaning it pays fixed dividends, which fundamentally attracts a different class of capital: fixed-income investors who prefer stability and yield over capital appreciation.
So they get exposure to Bitcoin's price appreciation through Metaplanet, but they are drawing in conservative fixed-income money, not just growth-seeking equity investors.
Precisely. It positions Metaplanet as a Bitcoin yield proxy without forcing dilution on their common equity holders. And critically, Norway's sovereign wealth fund endorsement is a massive precedent. It validates BTC accumulation as a strategy that even ESG-focused sovereign funds can indirectly support via compliant financial structures.
It seems like institutional adoption is now moving vertically, from sophisticated corporate balance sheets to the mining infrastructure itself, which brings us to the consolidation tied directly to the stablecoin giant Tether.
That's right. Northern Data, a firm partially owned by Tether, sold its Bitcoin mining subsidiary, Peak Mining, for $200 million.
And the buyers are the key detail here.
Absolutely. The purchasing entities were controlled directly by Tether's own executives: CEO Paolo Ardoino and CFO Giancarlo Devasini. This serves a dual strategic purpose. On Northern Data's side, it cleans up their balance sheet, maneuvering them into a pure-play AI compute asset for a potential acquisition by Rumble.
And for Tether's principals, why consolidate this infrastructure directly under their control?
It's vertical integration taken to the next level. By consolidating significant mining capacity directly, they reinforce Tether's systemic importance to the Bitcoin network. It's a massive statement that the people who control the largest stablecoin also want to control a key part of the infrastructure that secures the underlying network. It's all about de-risking and enhancing their operational security.
As this institutional strategy matures, we see geopolitical actors making clear, nuanced pivots. We had a surprisingly bullish statement from Russia's central bank governor, Elvira Nabiullina.
That statement linked formal, regulated Bitcoin mining directly to contributing to the ruble's strong exchange rate. This is a huge ideological shift for Russia, effectively formalizing mining as a clear geo-economic strategy. It uses cheap domestic energy-to-currency arbitrage to generate foreign reserves and bypass sanctions.
Meanwhile, Hong Kong is deploying a highly targeted two-pronged strategy. They proposed a regulatory stick, a 100% risk charge on crypto assets for insurers, effectively treating crypto as the highest possible risk asset.
That's the deterrence side. But simultaneously, they offered a regulatory carrot, proposed capital incentives for investment in Web3 infrastructure, specifically citing the Northern Metropolis Tech Hub.
So they want the builders.
Hong Kong is signaling they want the builders and technology companies, the picks and shovels, but they are actively discouraging traditional financial institutions from simply holding speculative assets. They want innovation, not speculation.
Finally, let's talk about the plumbing, which shows the real utility acceleration. The Lightning Network is hardening at a rapid pace. LQWD Technologies reported routing a record volume of over 2,012 BTC in December alone. That's a massive 61% month-over-month surge.
It's a huge surge. That volume is crucial validation for the medium of exchange thesis. The network is actually being used, not just talked about. And complementing this retail utility, BitGo just announced the integration of Lightning into its qualified custody platform.
Why does BitGo's move matter to the institutional side? Isn't Lightning mainly for small payments?
BitGo is a primary custodian for huge institutional players. By supporting Lightning, they are moving it beyond the scope of a fast retail payment system and transforming it into institutional settlement rails. Trading firms can now use Lightning for near-instant, high-frequency settlement and exchange arbitrage.
So it makes everything faster and cheaper.
It makes the entire global Bitcoin market fundamentally more efficient by reducing the friction of moving large blocks of capital.
So if we synthesize this entire dichotomy, the short-term market noise, the price consolidation, the technical fragility is masking a historic acceleration on the long-term infrastructure front.
Absolutely. The infrastructure is racing forward even as the regulatory credibility takes a hit from scandals like the Blanche Memo. We have the PARITY Act, fixing utility problems, Metaplanet demonstrating ingenious financial engineering, Tether executives actively consolidating mining power, and Lightning becoming an institutional settlement layer. The long-term thesis is being built out rapidly while the short-term market is simply waiting for clarity.
So what does this all mean for you, the investor, looking at the immediate future? What is the single most critical level that determines where the market goes next?
We need to watch the $87,000 support level closely. The market is just waiting for a trigger. A breakdown there could finally precipitate the expected minor capitulation event, the flushing out of weak hands that often precedes a true cycle bottom.
But on the other hand,
conversely, the smart money we discussed, Metaplanet, Tether executives, is actively using this consolidation phase to aggressively acquire infrastructure and assets. That strategic positioning strongly suggests that despite the short-term market tension, the foundational belief in the long-term thesis remains completely intact.
and here is a final provocative thought for you to chew on this week. We just saw Norway's $1.5 trillion sovereign wealth fund indirectly endorse Bitcoin accumulation via Metaplanet's sophisticated preferred stock structure. If that template works to manage dilution and attract fixed income capital in a compliant way, what happens when other major cautious sovereign wealth funds, those currently restricted by strict mandates, adopt similar financial engineering structures to gain clean exposure? Think about the magnitude of compliant capital that may be sitting on the sidelines waiting for this exact elegant loophole.